Brad Williams, Frugal Finance, bottom-up betas. Breaking down betas into their business operating leverage and financial leverage components gives us another way of figuring out betas, whereby we don't need past prices on an individual company or assets to estimate its beta. In the previous session, we were using regression betas, historical data, and a lot of number crunching. Here, we're going to use the most recent data in order to come up with betas. And I've talked about betas ad nauseum. Well, this will wrap up betas, but this is a pretty good explanation. So I'm going to go through and explain this one more time. To build this improved method, we need to introduce an added feature that betas possess that proves invaluable. The beta of two assets put together is a weighted average of the individual asset betas with the weights based on market value. So what you're doing is, it's called the law of large numbers. What we're going to do is we're going to try to gather as much information as we can regarding a company and its comparables. Then we're going to crunch all the betas together. And in the end, we're going to get a weighted beta of the markets. Is that better? Well, generally speaking, yes. So the beta for a firm is a weighted average of the betas of all the different business it is in. Thus, the bottom-up beta for a company, its assets, or its projects can be estimated as follows. Identify the business or business segments within the company whose beta we are trying to figure out. Most companies give a summary of their revenues and operating income by types of businesses in their annual reports and financial filings. Calculate the average unlevered betas of other publicly traded firms that are primarily or only in each of these businesses. In making these assumptions, we have to think about the following estimation. Comparable firms. In most businesses, there are at least a few similar companies. In some businesses, there can be hundreds. Start with a narrow description of comparable companies and broaden it if the number of comparable companies is too small. Beta estimation. Once a listing of comparable companies has been prepared, we need to figure out the betas of each of these companies. Optimally, the beta for each company will be estimated against a common index. If that proves unrealistic, we can use beta estimates against different indices. Unlever first or last, the debt-to-equity ratio, tax rate, and beta for each firm in the comparable firm list can be used to calculate an unlevered beta for that company. Otherwise, we can calculate the average debt-to-equity ratio, tax rate, and beta for the sector and unlever using the averages. We would advise using the last method based on the standard error of each regression beta. Averaging approach, the average beta across the comparable companies can be either a simple average or a weighted average, with the weights based on market capitalization. Statistically, the savings in standard error are larger if you use a simple average. Adjustment for cash and marketable securities have betas close or near zero. So the unlevered beta that we calculate for a business by looking at comparable companies might be changed by the cash assets of the company. To figure out an unlevered beta, cleanse the cash, we're going to go unlevered beta corrected for cash is equal unlevered beta divided by 1 minus cash divided firm value. When the result is expressed as a percentage, it is commonly referred to as a pure play beta, meaning that it just represents the risk of the firm and not any other corporate assets. 3, calculate the unlevered beta for the company. We take a weighted average of the unlevered betas using the proportion of company value derived from each business as the weights. These company values will have to be estimated because segments of a company generally do not have market values available. If these values cannot be estimated, we can use operating income or revenues as weight. We refer to this weighted average as the bottom-up unlevered beta. It is often a good idea to calculate 2 unlevered betas for a company, one with a beta of 0 for the company's operating assets alone, and another with a beta of 0 for cash and marketable securities. Calculate the current debt-to-equity ratio for the company using market values if available. Otherwise, use the target debt-to-equity ratio specified by the company or industry debt. Now, be sure, debt to equity, not debt to capital. Estimate the levered beta for the equity in the company in each of its business segments using an unlevered beta for from step 3 and the debt to equity ratio from step 4. Naturally, this approach rests on your being able to recognize the unlevered betas of individual businesses. There are 3 benefits when using bottom-up betas, and they are important. We can estimate betas for companies that have no previous price history because all we need to do is identify the business or business segment they operated in. In other words, we can estimate bottom-up betas for initial public offerings, private business, and divisions of companies. The beta for the business will typically be more accurate than the regression beta estimate for any one company because it is determined by average over a large number of regression betas. The number of similar firms utilized in step 2 will determine the standard error of the beta, which can be roughly calculated as follows. Average beta is equal to average divided by the square root number of firms. So the standard error of the average of the betas of 100 firms, each of which has a standard error of 0.25, will be only 0.025. 0.25 divided by 100. The bottom-up beta can point out current and even impending adjustments to a company's business mix and financial leverage because we can alter the combination of businesses and the weight of each business in making the beta estimate. Bottom-up beta for Granite Construction. Granite Construction is an engineering construction firm with diverse holdings. The transportation, water, and specialty segments are predominantly in the public sector and include certain federal agencies, State Department of Transportation, local transit authorities, county and city public works departments, school districts, and developers, utilities, and private owners of industrial, commercial, and residential site. Customers of their material segment include internal usage by their own construction projects as well as third-party customers. The majority of business is in the United States. To estimate Granite Construction's beta, we broke their businesses into 4 major segments. We have transportation, that has constructed some of the most iconic and complex transportation projects in the United States, developing urban and rural transit programs that connect millions of people, freight, and products every day. Specialty construction provides solutions to a variety of segments, including tunnel, power, mining, oil and gas, and renewable energy, and more. Water-related construction, Lane, a Granite company, is a global water management, mineral exploration, and drilling company. They provide responsible infrastructure solutions for natural resources in water, mineral, and energy, while offering innovative, sustainable products and services with an enduring commitment to safety, operational excellence, and client satisfaction. Well, clearly, that is their marketing people spinning their company. Materials, Granite mines quality aggregates that fuel infrastructure, including asphalt, concrete, aggregate, specialty sands, and rock. This segment replicates Granite Construction's reporting in its annual report. In reality, there are a number of smaller businesses that Granite Construction is in that are entrenched in these 4 businesses. For the 4 businesses for which we have in-depth information, we figured out the unlevered beta by searching for comparable companies in each business. Worksheet 2.13 sums up the comps found in the unlevered beta for each of these businesses. So we have businesses, the comps, number of firms, betas, median, market value, debt to equity. I use market value, debt to equity, unlevered beta, cash, firm value, beta less cash, and I didn't do the calculations. I just pulled this information from somewhere else. So we have transportation, specialty materials, water, and the engineering. I use 39 firms. You can see their median beta. Materials 72, 54. To obtain the beta for Granite Construction, we have to estimate the weight that each business is in as a company. The value for each of the divisions was estimated by applying the typical revenue multiple at which comparable firms trade at to the revenue reported by Granite Construction for that segment in 2021. The unlevered beta for Granite Construction as a company in 2021 is a value-weighted average of the betas of each of the different business areas. So here, all I did was I just compact all this information. We have this information. We have this unlevered beta here of 0.7. Got that? All I did was, you can just do a weighted average and and you're going to get 0.7. Add this stuff up, and the equity beta can then be calculated using the current financial leverage for Granite Construction as a firm. Combining the market value of equity, $1,817 million, with an estimated market value of debt, $399 million, we arrive at the levered equity beta for Granite Construction's operating assets. Debt to equity of 21.95 for Granite. Equity beta for Granite Construction operating assets, we're going to take 0.7 times 1 plus 1 minus the tax rate times 0.21. This will be their debt to equity ratio. And we're going to get an equity beta Granite of 0.818. You can see we went from 0.7 at leverage, 0.818. These are the estimates of unlevered beta and equity beta that we will be using for the rest of the lessons. When analyzing operating assets, we can also compute an unlevered beta for all of Granite Construction's assets, including its cash holding and the resulting equity beta. But we're going to get this number. We got this 0.77. Equity beta for the entire company, 0.894. This is pretty self-explanatory. We just broke this down. Pretty self-explanatory. We can compare this equity beta to the regression beta of 1.4. Big difference. We go from 0.894 to 1.4. Clearly it's lower. It is also more exact because of the averaging and identifies Granite Construction's current mix of businesses. There will be far less call for us to use these cash adjusted beta values in analysis. Bottom up beta for construction company. Bottom up beta for capital construction. We cannot estimate a regression beta for capital construction, a private company, because it does not have a history of past prices. We can, however, estimate the beta for capital construction using the bottom-up approach. We list the betas of the firms as well as debt, cash, and equity here in 2.15. So what I did was I gathered this list, and it's engineering. So I have engineering construction. There's probably 39 companies here. Here's their beta. Then we have market debt to equity. We unlevered the beta. Then we took the cash and firm and we netted it out. Here I took the median. It's up to you. I generally take the median. If the numbers are so skewed, you could have these crazy outliers, be crazy numbers, okay? On the betas, you could have some off the chart numbers because their income is so skewed. If that's the case, you want to use median. If it is something like this, and then construction companies are fairly stable, then you could use the average. I just have always used the median. It's up to you. You can see blanks. That means these companies are not doing very well. Why? That means they probably have losses. You can't have a negative beta. So you could see why you want to use the median because of the variability. You want to smooth this thing out as much as possible. So I use median. Again, you can practice, and if you're getting better results relative to your investments and your valuation, use average. Even though the companies in this example are very different in terms of market cap, the betas are consistent. To estimate the unlevered beta for the sector, we first unlevered the beta for each firm and corrected each unlevered beta for the firm's cash holdings. The median value for the unlevered beta corrected for cash is 0.6519. I'm thinking, okay, that's the unlevered beta. Because the debt to equity ratio used in computing leverage betas are market debt equity ratios, market. And the only debt equity ratio we can compute for capital construction is book value debt equity. We have assumed that capital construction is close to the book industry median, debt to equity ratio of 28.34. Using a marginal, this is saying a median. When I use median, I get 0. If I use average, I'm going to get 28.34. This is the median. Here's the average. When you're seeing something like this where the median is showing nothing, you're going to want to probably switch over and use average. Using a marginal tax rate of 0.25% for capital construction, we get a levered beta of 0.79. Levered beta, 0.65191 plus 1, 28.3479. Brad Williams, Frugal Finance. Thanks for watching.